Olivia, good to have you with us. Timely topic you've achieved expertise in with 79 some odd baby boomers, million baby boomers. You head up, among other things, the Pension Research Council.
That's right, at the University of Pennsylvania at the Wharton School.
And in terms of pensions, let's do a broad question first. I'm old enough to remember, unlike you, the late 70s when there was very real concern about pensions. And then, in effect, what bailed us out was inflation was conquered, booming stock market, interest rates came down, asset values shot up. Mm-hmm. Any hope of that in the future?
Well,
or let's say if it happened, put aside at the moment the public plans, if that happened, wouldn't that take a lot of pressure off? You get more realistic discount rates, you would get asset values growing again.
Certainly the pension structure in the U.S. is in grave trouble. State pension plans, state and local municipal plans are underfunded about $3 trillion worth, probably about 65% funded if you do the math their way, probably about 30% funded if you do the math, I think, the more accurate way. Corporate plans that have traditionally been of the defined benefit variety are also in trouble. They invested a lot of their assets in equity, and they haven't contributed what they should have contributed over the years. So yes, if markets went up again, that would help for sure. But the more fundamental question is, are we valuing the promises correctly, and are we contributing enough to pay those promises? And I have grave doubts about the ability of individual employers to manage capital market risk, interest rate risk, longevity risk, and so forth.
Now, let's first deal with the question about are we going to have retirement? You pointed out 100 years ago, you just worked till you dropped. Now, you say, especially with younger baby boomers, they may be working a lot longer than they anticipate.
I think the definition of retirement has changed dramatically from even 20 years ago or 30 years ago. When my parents' generation reached retirement age, they had a pretty comfortable Social Security, a reliable Medicare, their house value had stayed up, they had a nice pension and good retiree health. If you look at the baby boomers, and I'm one, what we face is a much more fragile public sector set of promises, Medicare and Social Security. I have never had a defined benefit plan in my career. So it's always been a 401k or 403b, which you see rise and fall. Our housing values are in trouble, and very few companies are offering retiree medical. So I call it a great insecurity that we face rather than retirement security.
And what is to, let's start first with the public plans. Mm-hmm. You say $3 trillion. That assumes a low interest rate discount?
So the $3 trillion estimate assumes that you use something close to what we used to call the Treasury risk-free rate. I say used to because Treasuries have become a little bit sketchier lately. But the number is somewhere in the 2 to 3 trillion range, I would suggest, based on the best evidence. The problem is that the states and the municipalities have been using much higher discount rates, which makes those promises far away seem very small right now. They use numbers that come from their estimated returns or their expected returns on their assets. I believe those are overly optimistic.
7-8%?
Sometimes even higher, that's right.
And longevity's been greater than they anticipated? Or they just willfully ignored longevity tables?
Longevity is a tricky issue because obviously every pension scheme and every medical scheme has to project how long we're going to live to be able to figure out what the expense will be. And longevity has increased about a month a year for the past 30 years. So we have some idea of that progression. Now, I will agree, some plans have just arbitrarily selected an old-fashioned, out-of-date mortality table, which means they're going to run short for sure. Looking into the future, what we're not sure about is whether the improved health of our cohort due to less smoking will be offset by the decreasing health of our cohort due to more obesity and more sedentary lifestyles. So there's a huge debate now among the actuaries about which way this will go.
Now, on the public side, what is to be done? Or you're going to see more fights on raising the retirement age, more co-contributions, finding ways to change constitutions? Is that going to work?
It's very interesting to have watched over the last year what's been emerging. Some states surely are raising contributions by employees, and I think that's inevitable. Of course, many of these plans are collectively bargained, which means that the union has to be brought into the negotiation. In some cases, states are trying to either raise the retirement age, increase the number of years needed to vest. What you've started to see happen is a reduction or even an elimination of the cost of living adjustment associated with the pensions. And even though I'm an economist, not a lawyer, the argument seems to be those COLA adjustments are not part of the base benefit, so that doesn't take changing the Constitution. What worries me even more, however, is that some states that are very underfunded are going for broke. They're undertaking extremely risky investments, hoping that on the upside, maybe they'll make money, and on the downside, well, they're already in trouble. And that, I think, is something taxpayers should pay a lot more attention to, since they're going to be the ones that might have to fill in the gap if there is one.
Can you name the states that are, in effect, buying lottery tickets?
Well, there are a number of states that are projected to exhaust their benefits by the year 2020. In other words, they won't have enough assets, even assuming a very high rate of investment return. And Illinois is on the list, Hawaii's on the list, there's several others. But the problem is that all of those assume this very optimistic discount rate. If you take a more pessimistic view, which of course I do, it looks like a whole lot of states and many cities, Philadelphia included, will be in deep trouble.
You had some numbers on unfunded liabilities per household, not federal, but state or local. Philly was what, 17,000?
On that order. And the issue is, of course,
Chicago, you had 42,000.
Right. So the absolute numbers are enormous. Now, pretty soon, a resident of Chicago or Philadelphia might be asking him or herself, do I really want to live in this jurisdiction? It might make more sense to simply move across the river or over the bridge or across the street so that I don't have to bear the burden of this additional unfunded tax. The irony of this, and something that people don't understand, is that the taxpayers of Philadelphia today are being asked to pay for garbage collected 40 years ago, police services that were provided 20 years ago, teacher services for their parents and grandparents even. And so that's the problem with this underfunding. You're passing on the costs of today's consumption to the future, and that raises a fundamental fairness question.
Politically, it's inevitable. People just look at the next cycle, and so it's very easy to make a promise if somebody else is going to have to pay it in 20 years. How realistic is it to have an effect in the public sector what we had in the private sector, and that is 401ks equivalents? You put in the money, you eat what you kill, in effect.
Well, we have to think about how to handle the liability costs, the legacy costs from the past, and how to handle the situation going forward. Some states, Michigan being one, Alaska being another, have already put in place a defined contribution 401k type plan for new hires. And so that helps, but they are technically, under the constitutions, unable to go back and renegotiate the deal for any retirees or any active workers who are currently in the positions. So that makes it very difficult to alleviate the underfunding problems for another 30 or 40 years.
Is there no way that these funds can't do what companies have done, and that is we fund what we promised you up to now, and then afterwards it's a new system? You're not taking away. It's not as if you're saying I'm taking away benefits promised in the past. You're 45, okay, up to 45 we do it, but after that you're on a new system.
So as you correctly note, in corporate America, what you have vested and protected is accrued benefits based on past service and past salary. In many states and municipalities, they've negotiated this future promise as well. And so in many cases, it's going to take going to court. It may take going to the state Supreme Courts. It may even take going to the U.S. Supreme Court to try to resolve this issue of how to handle contracts that cannot be paid.
Interesting, as they say. So even if we have a repeat of the 80s and 90s in terms of huge asset value increases, you're in effect saying on the public side, we're hitting the wall. We can put it off a few years, but it's no way we can paper it over.
It's going to be very, very tight and very unpleasant because the states and municipalities can't collect the revenue. They've had a 30 to 40% decline in revenue from their tax base, and there's no obvious way that they're going to make that up in the near term.
So let's go to the federal disaster, Social Security. Is that quite as bad for those who are on the system or about to go on the system? Are there tweaks that can be done, adjusting how you define cost of living increases?
Well, as you may know, I served on the President's Commission a decade ago where we still had a chance. We still had revenues coming in that exceeded the benefits that were being paid to my mother and many other people who were already retired. At that point, what we suggested was two things. One is changing the benefit formula so it didn't rise as fast. No cut, just so it didn't go up as fast. And the second option...
Does that mean tying it to
wages, tying it to prices instead of to wages.
Right.
And that single change, which I still think we should do, would bring the system slowly back into compliance and solvency. The other change, of course, we proposed was personal accounts on an optional voluntary basis. It's not obvious to me we could ever get that through this round. But the big change, the thing that brings the system back into solvency, is actually a change in the benefit formula. I computed at the beginning of my work with the Commission that if my two daughters had the same exact lifetime earnings as I did, they would get a benefit that would be 60% higher in real terms than mine. And that's the nature of the benefit enhancement that is built into the current formula. So what we have to do, I think, is change the formula. We need to probably alter the cost of living, but that's not going to save the day. Some folks have recommended raising the cap so that more of your earnings would be subjected to the payroll tax. That's going to be very expensive for people at the cap. But even that would just change the solvency date a couple of years. It's not powerful. I think if we all worked longer, that would probably help as well. And it would help the system, but it would also help us, because research shows that continued work is much more likely to leave you a healthier, happier individual. Early retirement, by and large, is not good for us.
You've mentioned that the definition of retirement has to change. You may not be doing your old career, but you're going to be doing something else, at least part-time.
One of the things we've seen over time is a change in the self-image that people have during their second, third of life, if you will. We have a big study called the Health and Retirement Survey. We've been doing it from 1992. It goes out again every 2 years, and we bring in new cohorts as they age and follow them. So we've compared the early baby boomers with their predecessors 12 years before. And what we find is the early boomers, and I'm in that group, think about continuing to work, working part-time, starting a new career, starting a new company, volunteering, doing a much more active set of things than the previous generation had in mind. The fact that we're now in a continued recession and financial downturn, I think, will only extend that notion that people will have to continue working because their nest egg isn't what they hoped it would be.
Now, in terms of attitudes, are they across the board, or are there certain cohorts, as you put it, that still think you just go out on the golf course?
Well, obviously there's people, my husband included, that would like to go out on the golf course. But, you know, the question is partly an ability to retire early. Frankly, it's very, very expensive to live to be 80 or 90, or as the actuaries are now suggesting, 100 or 120 years old. One of the problems I see is that people tend to go online and work with their retirement calculators. They ask you your age and your sex, and they say, boom, you have 16 years left or 18 years left. And then they help you try to figure out how not to run out by that point. But of course, you might live another 20 years beyond that. And if you do, that's the risk, the longevity risk that we have to keep in mind.
Given that, why do so many people, I think the majority, on Social Security start at 62?
That's a very good question, because as we know, the benefit formula is such that whether you claim at 62 or 67 or 70 adjusts. And so if you retire later, if you claim later, you get a higher benefit, exactly compensating you for the additional years. But one of the things I've found in my research is the way we frame the discussion about claiming dramatically influences people's behavior. So up until a couple of years ago, Social Security would use what they call the break-even analysis. And here's how it goes. You go in to talk to your Social Security field agent, and he says, let's say you're entitled to $1,000 a month if you claim at 62. If you delay 1 year, you will get a higher benefit, maybe $1,127 a month, say, just to pick a number. But, and they use this language, you will forfeit the $12,000 a year that you would have gotten during your 62nd year of age, and you will have to live 14 more years for sure to make up that shortfall. So the normal average individual would say to himself, well, I don't know if I'm going to live that long, and I don't want the government to take my $12,000 and forfeit it. So, of course, they claim at 62. So in an experimental setting, what we've done is we've shown people alternative ways of framing that claiming decision, including, for example, starting out and saying your normal retirement age is 67. You can take it a year early, you can take it a year late, here's what you get, what are you going to do? Guess what? They all say 67, or something later than 62. So the way we've been encouraging people to think, my belief is, has led them to claim early, with potentially negative effects for them.
Does that spill over into the workplace itself, because you get a penalty with earnings before a certain age with Social Security?
So there is an earnings test. If you claim at 62 and then return to work, up until 67, say, they do reduce your benefit. However, what most people don't know is they give it back to you once you hit your full retirement age. So everybody's fixated on this tax pre-normal retirement age, and nobody's ever explained that, hey, you get it back and you're left whole, and maybe you're healthier as well. So that's a big part of my research, that we're trying to think of different ways to explain this to people.
Now, on 401ks, most companies do what they call defined contributions versus defined benefits.
Mm-hmm.
In fact, you get to eat what's only in the plan. There seem to be a lot of problems with it. One is overconcentration. People don't diversify.
So from the time 401k plans really got started, which was in the early 80s, employers tended to offer them without much thought to what was in the investment menu. Frequently, they would have company stock in that plan. And frequently, if there was an employer match, the match would be in company stock. So what you saw is that many average employees, not knowing what to invest in, not being expert in the market, would say, well, if the employer's putting his match in stock, well, that must be a good, I know about this company, let's put more in. And people would double up and end up undiversified. Now, with the advent of Enron and WorldCom and Tyco and all the firms where people lost a lot of their retirement nest egg, there is more understanding on the part of plan sponsors that they should actually help you diversify. Moreover, the Pension Protection Act of a few years ago put in place certain diversified funds called target date funds, which the government views as acceptable and reasonably diversified. So if the individual employee doesn't know what to invest in or just can't be bothered to choose, then it's perfectly legal and okay to put that person into the target date fund.
Good concept. Does it really work, target date funds, in terms of performance?
So what we've shown in our research is that, of course, there's a million kinds of target date funds, but in our research what we've shown is that it tends to get people out of the extremes. So the people that were 100% in cash end up somewhere in the middle, and the people that were 100% in stock end up somewhere in the middle, depending on their age, because they're age-weighted. And it's our belief, based on historical evidence, that they will be better off in retirement substantially by having diversified their portfolio.
Now, talking about longevity, when people reach their early 60s, they immediately think of a time horizon, 4 years, 5 years. As you point out, maybe 20, 25 years, which means you should probably be in equities. Yet at the same time, you don't want to run out. So is there a mix? Do you advise people on a mix in terms of annuities? Should you buy a fixed annuity at age 60, at least knowing that you have that as a foundation, whatever happens?
Well, I'm a big proponent of annuities for retirement for at least part of your portfolio. How much you want to buy ought to depend on how much you're relying on Social Security and how much you trust it will be there, how much you are relying on a corporate defined benefit plan. Many people may be already sufficiently annuitized and not require additional. On the other hand, someone like me that I'm covered by Social Security but never had a defined benefit plan, I ought to be thinking more about longevity protection so I have a paycheck for life so that I don't run out the day after I hit my life expectancy. Now, the other thing to mention is that there are fixed annuities. There are also variable annuities. And so we want to think about the mix there as well. I am a big fan of an inflation-indexed annuity, of which there are very few offered in the U.S., I have to say. But the notion is if you're going to be alive 30 years in retirement, inflation can be very corrosive. So we want to maintain some minimum consumption level and purchasing power. That, I think, is a good idea.
This gets then to the kind of crazy environment we're in. Traditional things like laddering your CDs, annuities and the like, get badly skewed because of lack of an interest rate, and you end up getting very little.
It's absolutely correct. I think this interest rate environment has generated one of the biggest wealth shifts away from savers and retirees to the groups that are benefiting from low interest rates. And it's really very difficult. I'm trying to help my mother manage her pennies in retirement, and there's no interest to be earned. So if you're already retired...
Even tips.
And I'm a big tips fan, but I do regret...
They're no good anymore.
The problem is there really isn't anything that risk-free. So people have talked about diversifying abroad, but of course we know the benefits of that are somewhat less than we used to hope. If you still have an opportunity to keep working, to me that's one of the very important degrees of freedom that boomers have. Unfortunately, my research has suggested that probably the generation of people 50 and over is just going to consume a lot less because their houses are worth less, their retirement accounts are worth less, and that's going to be a belt-tightening environment that we're going to live with for a long time.
Even if we get a repeat of the 80s and 90s?
So, it's possible that we could have a repeat of the 80s and 90s. The world was very different then. We had a much more robust global economy. We weren't so closely synchronized all around the world. We have an aging global environment now where everybody, China, all of Europe, much of Latin America, of course us, Japan leading the way, and Singapore as well. So everybody's struggling with this problem of where to find growth opportunities, and it's going to be a tough call.
And you don't have gray hairs.
Well, we do things about that.
One final question. In terms of looking overseas, we were discussing before we went on tape, you do consulting for areas like Chile, Singapore, and I think eventually you are going to see one way or the other with younger people personal accounts with proper rules of diversification and the like. What lessons can we take from Britain, Chile, Singapore? Because one of the nice things about having your own account is you choose when you retire. If you want to do it early, bless you. If you want to wait to 95, you live that long, you can do it.
Well, one of the things that we've seen from Singapore is that people have been required to save their whole lives. And so they're able to reach retirement with a nice nest egg. However, in the past, they've been able to take the money as a lump sum and not necessarily protect it for retirement. So the government, as of 2013, will start to mandate a deferred annuity. The idea is that at 55, you buy yourself an annuity that will kick in at 75 or 80. So it's not that expensive since it's so far away. And this will merely be the amount of money you need to pay yourself a subsistence income. You don't have to annuitize everything, just enough to cover a poverty line paycheck. This way the government protects you and itself against people coming back later with their handout. And Singapore is not a welfare state type society, so this is something that's taken its place. In Chile, they allow annuitization or a phased withdrawal, so you still run the risk of the longevity possibility. In Australia, they also have a mandatory system. 9% of pay must be put in defined contribution plans in the main. You have a lot of choice where to invest the money. The downside there is they let you take the lump sum. And so unfortunately, some people at age 55 take the money and go on their overseas experience and then come back and ask for a bailout when they're older.
So if we do something like that here, we'd have to have a minimum age before you can annuitize, say 60.
Well, when I was on the
targeted funds.
When I was on the Social Security Commission, we struggled a lot with the question of should we mandate an annuity if we had a personal account. And we ended up making a proposal somewhat like the Singaporean. That is, it's your money, so you should be able to access it. On the other hand, we don't want you to go blow it, so and buy a bass boat or what have you. So, not that I have anything against bass boats, but the point was we wanted to make sure there was a minimum level of protection. And so we also required partial annuitization in our proposal.
Are you going to ever retire?
Not if I can help it.
Olivia, thank you.
Thank you very much.